In our recent video blog, Rule of 25 Too Conservative, we suggested that for a 65-year-old couple looking to finance a 30-year retirement to age 95, the Rule of 25 provides a good starting point to determine how much investment wealth is required to provide the couple with a high chance of not running out of money. The Rule of 25 advocates that you should multiply your desired annual retirement spending by 25 years. So, if you wish to be able to spend $100,000 a year in today's dollars in retirement, you should aim to accumulate at least 25 times $100,000 or 2.5 million. The Rule of 25 serves as the benchmark for the retirement expenditure multiple, one of FinHealth's 5 key indicators of good financial health. It suggests that for financial independence at age 65, an investment wealth requirement of at least 25 years of expected future annual spending is a good guide. Underlying assumptions include: 1. You wish to finance 30 years of spending to age 95. 2. You own and will stay in your current home. 3. You have no other lifestyle assets or expected inheritances to draw on. And 4. As discussed in depth in our earlier video blog, your desired retirement lifestyle suggests an investment wealth requirement above that which would ever allow you to qualify for the Australian Age Pension. At the end of our previous video blog on the Rule of 25, we acknowledged that our focus had been on financing a 30-year retirement from age 65, ignoring the fact that most 65-year-olds won't live to 95. Some critics of the Rule of 25 suggest that overlooking this life expectancy reality means that it's too conservative, scaring potential retirees into thinking they should accumulate more investment wealth than most will actually need. The rest of this video examines the interaction of life expectancy with the Rule of 25. It concludes that while on average the life expectancy argument has validity, you need to ask whether you want to rely on being average. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. The chart now on the screen, included in our previous video blog on the Rule of 25, shows the chance of running out of money over a 30-year retirement period for multiples of desired retirement spending varying from 10 to 30 times. Please see that blog for the assumptions that we used. It suggests that with investment wealth of 16 times desired annual retirement spending, there is an uncomfortably high 68.6% chance that it would be insufficient to fund a 30-year retirement. But many personal finance experts have suggested that a retirement spending multiple of 16 is a reasonable investment wealth target. How might we reconcile these apparently contradictory pieces of information, ignoring the possibility of access to the age pension? The chart now shown, consistent with the previous chart, shows the chance of running out of investment wealth by age, assuming 1. Initial investment wealth of 16 times desired annual retirement spending, and 2. Both members of a couple surviving to age 95, that is, they both enjoy 30-year retirements. It shows the chance of consuming all investment wealth begins to rise steeply beyond age 80. But the reality is that most people will not enjoy such long retirements. The charts now shown, extracted from Australian life expectancy tables, courtesy of Net Actuary, show for a retiring couple, both currently aged 65, 1. The probability that both partners are still alive for ages 65 to 95, and 2. The probability that at least one partner is still alive for ages 65 to 95. Chart A reveals the chance that a couple both survive 30 years from age 65 is only 5.7%. Chart B shows that the chance that at least one of a couple survives to age 95 is a higher 42.4%, but much lower than the 100% both parties surviving implied by the rule of 25 analysis. Next, we add to the earlier chart the chance of consuming all investment wealth by age, assuming at least one member of an average couple survived to age 95. As already observed, there is only a 42.4% chance that, of all couples currently aged 65, at least one will survive to age 95. That is, there is a 57.6% chance that neither will survive to age 95. Therefore, the chance of running out of investment wealth at age 95 and at least one of the couple surviving to age 95 is 68.6% times by 42.4% or 29.1%. So, at a national level, a multiple of 16 times desired annual retirement spending doesn't look so unreasonable. It can also be assumed that if one member of a couple dies before age 95, desired retirement spending will be adjusted downward without affecting the lifestyle of the surviving partner. This chart adds the expectancy that both members of a couple survive to age 95 and that desired retirement spending is maintained for 30 years to age 95. At age 95, as also discussed earlier, the chance that both members of a couple are surviving is only 5.7%. So, while there may be a 68.6% chance that investment wealth will be insufficient to finance a 30-year retirement, this will only be relevant to the 5.7% of the population that survive and continue to spend the initial desired amount. The chance of this happening is 68.6% times 5.7% or 3.9%, a low probability, again suggesting that, on average, a retirement spending multiple of 16 times desired annual retirement spending is more realistic than that advocated by the rule of 25. When considering the retirement preparedness of a nation, it's clearly appropriate to take life expectancies into account. But at the individual level, when deciding on how much investment wealth you estimate you will require to finance your desired retirement lifestyle, you need to consider whether you wish to rely on averages. If you believe you will live longer than the life expectancy tables suggest, and/or you wish to build additional conservatism into your investment assumptions, we maintain that the rule of 25 continues to provide a reasonable benchmark to assist you to answer the question, how much do I need to retire? Of course, if you are less optimistic regarding your longevity and/or more optimistic on future investment returns, a lower retirement spending multiple may be appropriate. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.